Hello, and welcome to the IRE.IQ Quarterly Fundraising Report review. Thank you for joining us for a look at closed-end real estate fundraising activity as tracked by our IRE.IQ database. We will be sharing some trends and data covered by our Q2 2026 IRE.IQ Fundraising Report, which was published last Thursday, August 13th. And I will be joined today by a pair of industry experts to discuss the broader trends affecting real estate fundraising and where the market might be headed. I will share a brief slide presentation with data and charts from the IRE.IQ fundraising report, and then we'll have a broader conversation about fundraising. And we will be answering questions from the audience through the Q&A feature, which you can access down at the bottom of the screen. Now, all the data discussed in this program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts. And it has tracked more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Publication sponsors receive access to IRE.IQ as part of their benefits package. But if you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. So now I'd like to welcome our panelists, Michelle Fang of S3 Capital and Chris Reel of Albourne. Hello, welcome. Hi, Michelle. Hi, Chris. Thanks for joining us.
Good to be here.
Yeah, thank you.
So I was hoping maybe we could start with each of you just sort of giving a brief overview of your role and where you sit in the fundraising ecosystem and what perspective that gives you on the market. And I'm going to go ahead and start with you on this one, Chris.
Sure. Thanks, Loretta. So I'm with Albourne Partners. I'm a partner with the firm, and I oversee our real estate investment due diligence function. So what that means is work with a team of analysts who spend their days underwriting real estate managers and real estate funds on a global basis. Our team covers the spectrum from core to opportunistic, open-end, closed-end, equity and credit, everything within the real estate ecosystem. And what perspective that gives us in terms of fundraising is we are in between. We're in between the LPs who are seeking to place capital and build out their portfolios or fill gaps in their portfolios, while also on the other side continually talking with the GPs who are raising funds to understand what their strategy offerings are, evolutions in products and structures and strategy. So it gives us kind of that middle point in between the two of talking to the LPs with the capital and the GPs who are seeking the capital.
Fantastic. And Michelle.
Great. I lead capital raising and investor relations for S3 Capital. We specialize in real estate credit and more specifically in construction lending. Our clients are a mix of institutional and high net worth investors, primarily located in the US, in Asia, in the Middle East and in Latin America. But we are talking to investors in Asia and in Europe as well. Prior to joining S3, I led global marketing and product development for a broadly diversified real estate firm with active strategies across the spectrum in all quadrants of real estate. So while my current perspective is more narrowly focused, it's informed by a broad background. And I guess I am somewhat in the middle too, if to echo Chris, in that I'm talking to both investors directly and also to the consultants who are guiding them in many cases.
Fantastic. Thank you. So I'm going to go ahead and start sharing our presentation. And as I said, we'll be running through this, just a very brief slideshow, and then taking questions from the audience. So those of you who are following along, do feel free to pop into the Q&A, ask some questions, share in the chat. So starting off, we're looking at closed-end funds investing in direct property, equity, or real estate debt. And I do think it's important to clarify that this is a snapshot in time. So this current report, it focuses on funds with a final close between April 1st, 2026 and June 30th, so second quarter. It is possible that additional funds closed during the second quarter, but haven't announced it and therefore haven't been incorporated into the data. And so we are constantly updating this data. The numbers do change a little from quarter to quarter. Usually it's smaller funds, to be honest. So it doesn't really move the needle that much, but we are constantly updating our data. Even still, I think the overall trends are useful. to indicate kind of what's happening in the market and to provide some guidance to investors and managers about where we're headed. So with that said, taking a look at the second quarter, we saw nearly $36 billion raised by 17 funds holding a final close. So far this year, we've seen 43 funds hold a final close and total equity of 63 billion. By contrast, in 2025, we saw 140 funds hold a final close, aggregate equity of 159 billion, and that was up 73% from the year before. 2024, I think we all recall, was not a solid year for real estate fundraising. How do these numbers, how does this sort of match up with what you're seeing in the market? And I'm going to start with you on this one as well, Chris.
Yeah, so I think this matches pretty well with what we're seeing. Is on par with what we would have thought at the end of first quarter. Albourne's view was that fundraising was roughly in par with 2025. Obviously, you will have some quarters that are a little bit lumpier when you have mega funds closing in an individual quarter might skew the numbers. But broadly speaking, the momentum feels like it's there. It's off a low base, as you mentioned. 2024 was pretty quiet for fundraising, but that picked up in 25 and seems to be more of the same so far in 2026. I think part of the other sort of swing factor here is classification too, right? There are some funds and strategies that could be an infrastructure fund, like a data center only fund, or it could be a real estate fund. If you start to move those one sector to another, you could get some pretty big swings. But I think directionally, the momentum feels right. And I think more than that, underneath the aggregate, kind of the distribution matters a little bit more than the total, meaning capital still seems like it's concentrating in a few of larger funds. And that's a trend that we've seen for a few quarters now and looks to be continuing, while kind of generally speaking, the time to final close remains pretty long for everybody.
Yeah, it is, I think, been a challenging fundraising environment for the past few years. And I think the numbers kind of bear this out. Any sort of opinion on what you're seeing, Michelle?
The only thing I'd add to that, and that was a great overview, Chris, is just that as I talk to my peers, I do think people felt really down in the dumps in 23 and 24 from a raising capital perspective. Last year started to get better, but it wasn't quite the spike in interest that people were hoping for or expecting. But I do think it's steadily improving, and so it lines up with that. I think it is somewhat surprising, and I know quarter by quarter can skew it, but at 2.1 billion for the average fundraise size, that's nearly double the average for the prior 4 quarters, which is really notable. Maybe
Yeah.
it's just noise, but it's notable.
Yeah, we've seen some big funds hold a close this quarter. The overall size does seem to be sort of ticking up. Um, with that, let me go on to the next fund, and I'm going to keep with you, Michelle, for this one because this is taking a look at debt fundraising as a percentage of the overall volume. Um, what would you say about the current debt fundraising environment right now?
I would say it doesn't seem obvious from the data that you shared, but as someone who is focused on debt, interest seems very strong and it seems to be growing. Some investors thought there would be distressed debt opportunities coming out of COVID and really the rising rate environment between 22 and 24. And for the most part, we didn't hear a whole lot of those materializing because the banks and lenders were able to extend and work with borrowers who I think were pressed. But today, most of the investors I am talking to that are looking at debt are looking at it for the cash flow. They've been disappointed with what they were getting or expecting on the core equity side, which has been lower all desired distributions and overall fairly anemic returns. So interestingly, there are some investors who I think are just starting out their real estate debt programs. They're looking for diversified funds to allocate to get broad credit exposure, and then start after that planning to specialize more. As a specialist, that's what I hear quite a bit. We'll see if that holds true, but it does seem to mirror what we saw on the private equity side, where investors first started out with more diversified funds and then got more specialized by sector and by strategy as things matured. And then I'll just add that a lot of allocators are still trying to figure out, where does real estate credit reside? Is it part of real estate or is it part of private credit? They're often seeking the same return profile regardless of where it sits, but the conversation can change quite a bit depending on where that sits and who you're talking to.
You know, one thing that we have heard for the last few years is that when it comes to real estate debt, investors are really interested in it, but it doesn't always seem that that interest has translated to actual dollars. Do you think are they finally starting to open their pocketbooks at this point, or is it still a little bit of a challenge to get that interest over the line?
Yeah, I do see it building to, I mean, I think originally when private real estate debt started to take shape, call it after the GFC, it was, you saw the advent of a lot of open-end debt funds, and that was compelling because investors were thinking, well, if it's an additive or a replacement for core private equity, then that structure seems to be good. I think a lot of investors got caught with funds that had high allocations to office, and those were hurt, so that then caused investors to kind of reassess what they were doing. At the same time, as you mentioned, there was a whole swath of investors that never even looked at that. And so they're coming into it as debt 1.0 versus those original investors that I'll say are coming into it as debt 2.0. But we are seeing it, especially because private credit really came in strong as part of overall allocator portfolios. And then I think that has also driven a return to saying, where else can we look at private debt-like attributes? Oh, we can look at it over here in real estate.
I was actually going to ask you about that because, private credit has had a little bit of a bumpy ride as far as headlines go in the past year. Not real estate debt, but private credit separately. And we're actually starting to see some interesting research coming out talking about how real estate debt, how to position it against private credit. That again, it's that same debt-like qualities, but that you have a hard asset. And so that when you make that comparison, it's actually a little bit of a stronger comparison when you think about where you're going to bucket your real estate debt.
I think that's right. I don't know that it's so much one versus the other, but more in terms of private credit portfolios are dominated by direct lending. I mean, 80 to 90% of the portfolio is direct lending. And I think investors are saying we'd like to diversify the sources of that risk and the downside protection. And so they're expanding more broadly to asset-backed opportunities, and real estate, of course, is part of that.
Chris, what are you hearing from your clients when it comes to real estate debt investing?
Yeah, it's interesting. It's a topic of conversation on most calls with clients. Clients are interested in understanding what's going on in real estate debt, what are the market dynamics, what are we seeing, right? And to Michelle's point, I think a lot of it is still a process of figuring out where it goes within the portfolio. And every LP is different, right? Some LPs have long had real estate debt allocations as a part of their real estate portfolio, but many did not. And so those groups are trying to figure out, does this fit, as Michelle mentioned, as a substitute for core or core plus equity based on current return and risk profiles? Or, and this is what I think I've seen a little bit more of, is a diversifier within the private credit book. So while our team that I oversee underwrites real estate credit, we're agnostic as to where it goes in a client portfolio. So clients might put it in their private credit portfolio, and we've seen really for the last year and a half more of that type of activity of private credit allocations being made. So far, it's been to multi-sector hard asset credit strategies, less so to asset class specific, so not as much real estate only credit. I think it's going to evolve that way. Once those portfolios start to build out, they can take a little bit more of a targeted approach. But the other part of it is there's still a bit of an education process to go through, right? We say debt, but debt is not one thing. That's like saying real estate equity, right? LPs don't just look at real estate equity and allocate to it, right? They look at real estate debt and then they figure out, do we want to be in transitional collateral? Do we want to be in stretch senior lending, mezz lending? Do we want to do more risky, NPLs or RPLs? We want to do construction lending. So a lot of it is talking about and getting to the point of understanding what are the different levers you can pull within real estate debt? Where can you position yourself in the capital stack? And what parts best fit your goals for your allocation? So we're still going through a lot of that process, it feels like, with LPs to figure out, number one, where does it fit in their portfolio? Number two, what do they want their real estate debt allocation to look like?
Mhm. Mhm. Um, I'm gonna go ahead on to the next slide, just reminding the audience that we are taking questions through the Q&A button. You may have to click on the more if you don't immediately see Q&A as an option. Um, you alluded to this earlier, Michelle. We saw a huge jump in average fund size. Average fund size in the second quarter was 2.1 billion. The median fund size was 1.3 billion, which is also quite large. Like it wasn't just sort of one big fund, although there was one fund over 10 billion. But we also saw five funds raise more than 3 billion. 11 of the funds raised more than 1 billion. Like this was very much a period of established large mega fundraising. Um, what are your expectations? What role are mega funds playing in the market? I'm going to start with you on this one, Chris. When you're working with clients, how are they seeing the mega funds versus the rest of the market?
Yeah, so mega funds, I think, are often looked at as a way to get broad diversification through a single commitment, right? Most of these mega funds are multi-geography, multi-sector, typically equity heavy, but can do some credit. And so you're getting a lot all in one commitment. These also tend to be larger organizations where LPs may have broader relationships, not just in real estate. And so it's a relationship play as well, to be allocating across multiple products and multiple offerings with these mega groups. And so the mega funds, I think, will continue to see strength, right? They do provide broadly diversified exposure to a number of pockets within a single allocation. So for LPs that may only have one or two allocations to make per year, you're getting the best bang for your buck. You're getting as much diversification as possible with that. So I don't think that's going to change, particularly in an environment where there's a lot of conversation about what's going to drive returns over the next cycle. It's going to be operational capabilities, the not just the beta influence of picking the right sector. And so going with these larger funds that have more resources, on both the asset management and execution side, I think that's a story that will continue to play well. And so I see the mega funds continuing to play an important role in the fundraising environment. And then, as you noted, they are complemented with the small, I say smaller funds, right? Still median sized over $1 billion is not exactly a small fund, but smaller funds compared to the 10, 15, $20 billion mega funds.
Well, I remember there was a time 20 years ago when a $1 billion fund was a mega fund. And now that's just sort of, as you said, that's the median. Now we're looking at significantly larger when we talk about a mega fund. Um, for these funds that, because you've seen, maybe more concentration with certain outfits, and fundraising has been a little bit slower the last, say, year, 2, 3 years. Are you starting to see increased stress at some platforms with that fundraising challenge?
Yeah, I think you can draw some conclusions that the stress is evident, not necessarily in headlines, right? But it's in things like terms when you're talking to managers. Terms are much more flexible these days to fit LP needs. LPs can be a little bit more aggressive, a little more in the control seat in a difficult fundraising environment when it comes to negotiating terms. And we're seeing willingness to do that from groups that maybe historically weren't as willing to provide custom terms for LPs. So when capital is scarce, it does pressure managers to be a little bit more flexible and a little bit more creative in the solutions that they're bringing. We're also seeing that recent vintages had protracted fundraising timelines, and a lot of them below target fundraises. And so what that means is some of these managers are coming back to market relatively quickly, right? They close, and you would normally expect, okay, they're out of the market for 2 years, and maybe this time it's 2 or 3 quarters, then they're back to raise the next fund. And so because they're already deploying what they've raised, compresses their revenue a little bit, and makes them a little bit more incentivized on the next go around as well to get that first round of capital in the door. Number one, to keep the fee streams going, but number two, they have pipelines, right? And you don't want to risk losing your pipeline. And if you run out of capital from the last fund, you want to have that next fund ready to go, and offering fee incentives is one way to be able to do that in a difficult environment. And then I think the other thing that's not in published data per se, but second order effects are things that you would all expect. Sometimes you see slight team reductions at the margins for groups that are struggling to raise capital, or you might see certain strategies quietly retired that used to be part of the product lineup but maybe weren't the flagship, weren't gaining a lot of traction, and so they quietly don't come back with the next vintage of what previously was not the flagship fund. So we're seeing a little bit of that as well.
Anything you want to add on any of these topics so far, Michelle?
I think only in that in conversations with investors, there's a real push pull or a tug of war going on, in the sense of you want to be able to deploy large amount of money for some of these large allocators, and you need to not dominate a fund, and so that wants you to be drawn towards large funds. At the same time, I think there is a concern that the larger the fund size, the harder it is to steer and harder it is to actually generate the returns that maybe first attracted an investor to them. So I think there's that natural tug of war that happens between fund size and manager and allocator interest. And I think in general, what investors are doing thoughtfully is saying, does the strategy get better with a large fund or get worse with a large fund, and thinking it through that way. And then to Chris's point, the fact that so many managers struggled to raise capital or to reach a critical capital close also meant that investors were drawn towards larger funds that seemed to have that momentum behind them. There was less of a willingness to take that risk and spend time underwriting, commit to a fund, and then either not see it close or close below its target. So Chris, you mentioned those first close incentives, and honestly, the last few years I've talked to investors, that's a soundbite, but they don't really care about that because what they really want is to make sure that they're investing with the fund that closes, and then yes, they'd like to get good fees, but they're not incentivized enough to by saving 15% or whatever it is off of a fee schedule if they don't have really strong conviction that they'll get to a final close at size.
Yeah, I agree. It's more of a carrot. It's not the leading factor, right? It's you have to have conviction in the manager and the strategy first. That's just how do you get people to move? Because it's been a lot of, well, there's no motivation. Number one, there's no risk of a fund, very little risk of funds having a one and done close today, right? So you don't have to be in that first close. So it's just different ways to try and incentivize people to come in early and help give that initial round close to kickstart the process.
Well, one of the conversations that I've heard quite a bit is around that fees for first close. And I think I've heard a number of investors kind of say that 25 basis points isn't enough to move the needle. Like they're not willing to take that first close risk for a fee break that doesn't feel like it's enough to sort of compensate that risk that the fund may struggle to get over that final close. I have a
That's
question.
healthy. That's a healthy perspective to say, okay, let's not lose the forest for the trees here. Let's first make our decisions and get in with the right fund.
Right, right. I have a question from the audience actually, before we keep going. What kind of alignment, for example, percent of co-invest, are LPs seeking from GPs? And is that increasing, reducing, or do you see it vary across strategies? Maybe I'll start with you on this, Chris. So again, what kind of alignment, for example, share of co-invest, do you see LPs seeking from GPs?
Yeah, I mean, clearly there's no one size fits all, right? Every LP's got a little bit different perspective on what elements of alignment they're most interested in. But certainly they want alignment in terms of capital investment, right? They want to know that the manager has skin in the game, and preferably you would like to see it be team members with skin in the game, not a parent company balance sheet that's investing a lot of capital, but the team actually does not have their own dollars at risk within a fund, right? Because obviously the incentive fee is there to reward you in good times, but you want the team incentivized to the downside too, at risk of losing capital if deals don't perform. And so while there's no magic number that I can point to and say it needs to be 10% or 20% or 30% of the overall GP commitment, it's certainly a factor. And it varies by fund, right? If you have a small emerging manager, they have less liquid net worth available to put into a fund, whereas a bigger manager that's on Fund 7 and the team has been earning carry for the last 6 funds, they should have more available to put into the fund. So, but I think directionally that's what LPs are looking for the GPs and it does vary across strategies, right? It's very uncommon to see much direct investment on the part of a manager or team in an open-ended core fund, for example, right? But in the higher octane closed-end value-add opportunistic funds, you do see more of a team investment to align both on the up and the downside.
Anything to add there, Michelle?
Nope, covered it well.
I'm going to move on to the next slide, and we're going to talk a little bit maybe about global fundraising. This is fundraising over the last 12 months, and this is by target strategy of the fund, not where the capital is coming from, but where the capital is going. So this is capital destination. And, one thing that I think is really interesting is that while this is over the last 12 months, we've seen, a huge allocation to the US, the Americas, which is, I would say, kind of the typical place that we've been. This is kind of where we've been over the last always, maybe. And what I think is really interesting is in the second quarter, we actually saw a big shift toward European fundraising. Only one third of the equity raised in the second quarter was targeted for the Americas, versus three quarters in the previous quarter. And another one third of aggregate equity was targeted toward Europe, Middle East, Africa, EMEA, up from only 15% in the quarter before. So, what are you hearing from investors related to non-US markets? And maybe I'll start with you again on this, Chris. Do you think it's non-US investors keeping their attention out overseas versus looking to the US? Or are we also starting to see US investors getting outside their domestic market?
Yeah, I mean, I think, one quarter is not enough to draw a trend, right? It's definitely interesting to see the even balance between Europe and US in the second quarter, but I don't know that's enough to say the two are on par. Even these trailing year numbers on the screen here show that the dominant region still continues to be North America. I would say from what we see from our clients, there is still a lot of home region bias. So the Asia Pacific investor is largely committing and reviewing AP funds. European investors, excuse me, largely staying in Europe. U.S. investors, for the most part, focused on North America. Where we see some variability is from Middle Eastern investors. They tend to be a little bit more flexible in their allocations, and I have seen a little bit more of that get focused on Europe so far this year. I think some of the U.S. policy noise has just made it easier to go elsewhere for a while, and so those who are very flexible in their geographies have diverted a little bit of capital to Europe. Excuse me.
Michelle?
Yeah, the only thing I'll add there is that I was in Toronto a few weeks ago, and investors basically said, "No, we're still looking to go to the U.S. for investments, but I'm not going to vacation there." That was it was an interesting break in sentiment there. So hopefully not for long, but yes.
They'll send their money, but they don't necessarily want to send themselves. That's interesting.
I mean, you're seeing, like Chris, you touched on countries that have fairly well diversified investor based like policies for a long time, right? But even like in talking with investors from Brazil, there's a move to try to encourage investors to get outside the home country because it's been so dominant there. So, and I think in that particular analysis, the U.S. still gets our fair share, which is a very big nut because of the size of the economy. So, and things fundamentally are pretty strong here. So yes, the policy noise is presenting some temporary pause, I think, on that relative to other regions. But maybe, Chris, I don't want to put your words in your mouth, but I think this might be a point in time, and I don't think it's something that we're going to see as a trend continue. Although they're great places to invest globally.
And then, of course, taking a look at investment style, we're seeing a pretty even split between value add and opportunistic. Obviously, and and probably everyone watching this knows that closed-end funds tend to be high return. Most of the core equity would be more in an open-end space, which is not being collected in this data set. Although I have been told that even if it were, we would not see these numbers much higher when it comes to core open-end equity. Um, I have I have a couple of questions, and one of them's actually kind of come in from the audience that I want to kind of maybe talk about here. Um, he asks capital raising for real estate versus infrastructure by risk classification. And he's asking, does the marginal core capital that would have been earmarked for real estate going to these big open-end core plus infrastructure funds? And, is that something, maybe just a gut feeling? Chris, does that line up with maybe what you're seeing?
Yeah, well, we have a separate team that covers infrastructure and covers all of those funds. They would have their finger more on the pulse of that capital raising. My gut says there is some truth to that, right? We all know the queue redemption queue pressures that a lot of the open-end universe has been facing within core real estate. Um, some funds have made some progress on that. Others it's taken a bit longer, and so I do think some LPs looking at that already had to increase a weighting to core infrastructure already. Perhaps they were underallocated. It's just been easier to focus their time there while they wait for the full value correction in the open-end funds, more of those queues to be cleared. So yeah, I don't have any hard data behind that, but that feels directionally accurate.
And one thing I will add, the 16 billion of not disclosed capital, that we have found often correlates with perhaps a debt fund. Debt funds are less likely to necessarily assign a label. Michelle, is that something you see in the market, looking specifically at sort of the debt side, that these sort of core value add opportunistic buckets maybe don't always work for debt funds in the same way they do for equity?
Yeah, I think it's the ways in which we label even private equity core value add and opportunistic have been blurred a bit too. So I think when you then add debt in the mix of it, pure credit strategies, it's a lot harder. So yeah, I think that's tough. One of the things that you mentioned, Chris, I suspect that it's maybe a little bit less a matter of allocating marginal dollars from core private equity to infrastructure because of core private equity's performance or lack of liquidity, and more of just, I mean, we started to see this even before COVID when real estate was still very strong and robust and doing more than, benching more than its weight in delivering returns. I think you started to see this expansion to real assets. And so there was a matter of how do we fund a real assets portfolio, and those allocators who oversaw real estate now found themselves overseeing real assets as a whole, right? And so even on the consulting side, like Chris mentioned, there may be separate teams having special expertise, but there's a lot of coordination and talk between the groups because it's all part of that move towards more private. But infrastructure funds on the closing side, they just tend to be almost double the length of real estate private equity funds, and so it's not an apples to apples comparison, but I think it's part of funding more privates. And where is that coming from? Maybe a mix of some real estate, maybe some public fixed income, maybe some public equities, that kind of thing.
Thanks. I'm going to move on to our sort of just some of the key takeaways. I'm not going to run through these word for word. Everyone watching, you will get a copy of the slide presentation, so I don't need to read this off to you now. But I do kind of maybe want to ask a few more questions and continue to take some from the audience. Michelle, are we in a sentiment change in the real estate market right now? I think you alluded to sort of a challenging period. Has the mood shifted, or what are you hearing?
I think the answer is yes. I just can't totally describe why it is, but we started using the words identity crisis about a year ago at some of the conferences I was going to and just talking to investors. But it's not as simple as just looking at real estate in isolation. It's about the resulting expansion of what's available to investors to invest in. It's even a move towards more total portfolio approach. That's starting to define the way that investors approach. So I think we are in somewhat of an inflection point, and where investors are asking themselves, we got really spoiled by very strong returns from real estate, stronger than what they were supposed to be, right? And they were starting to compete with private equity. And you saw that, right? And real estate probably doesn't in some forms compete with private equity, but real estate's gotten way more diversified. So I think there's just I think we're at a point, and maybe it doesn't revert back to anything where it's more simple. Maybe it just becomes one of those things where even if you don't call it total portfolio approach, investors are saying, what are the characteristics of your strategy? What are the drivers of risks? How do they correlate with the other drivers of risks in my portfolio? And then let me make moves based on that. It's far less simpler, maybe far more interesting.
Well, and I would say, the previous big sentiment change obviously can be tied right to sort of the rise in interest rates. You see an interest rate reset, everything kind of has to sort of reset around that. Now, would you say that the market's gotten more comfortable with the current rate environment, and it's just sort of like, this is where we're at. We can now we know how to deal with it versus 20 years of lower?
Less comfortable, more resigned is probably how it is. So I think you mentioned it earlier, but I think certainly the conversations have shifted to what is going to drive returns. It won't be a beta play, as Chris mentioned. It's not going to be cap rate compression. There's been a lot written, even the past 3 to 6 months, about focus on NOI. You see that going, operating income, operating drivers, all that stuff. It comes up from time to time. I think that's the period that we're in right now, rather than looking at sort of simply throwing your hat into the real estate ring and hoping it floats.
So I have another question from the audience. And I will before I raise the question. The of the of the funds that were closed, we did see actually quite a few of the sector-specific funds. Quite a few of them were focused on the residential market, residential broadly, not just multifamily, but also student housing, or other things. But a question about multifamily funds specifically, and I'll start you off on this, Chris. Are you seeing a change in allocations? They say it feels like in a world where we are moving toward an absolute return filter, multifamily suffers. Do you see that tide changing?
Yeah, I think, for multifamily, what we saw was obviously a lot of capital raised in 2020, 21, early 22. Debt was cheap. It was easy to buy multifamily. There was obviously we were cycling out of office already at that point, looking for somewhere to put that capital. And multifamily was a very demand-driven, demographically driven sector, easy to understand the drivers behind it, and so a lot of capital flowed in. And then a lot of LPs found themselves full on their multifamily allocation pretty quickly over the course of about 2 to 3 years. Maybe they went from underweight to overweight, a handful of percentage points. And then you think about what the performance of those funds has been. It's been challenging, right? It's no secret that DPI has been very low for those recent vintage funds, and so those allocations are still relatively full. So what I haven't seen is clients, LPs saying we really need to increase our multifamily allocation. We're very bullish and we want to continue adding, 10 percentage points to our allocation to multifamily. I do think from a um, capital rotation perspective, multifamily funds might suffer in because LPs are looking at other forms of residential now, other forms of living, right? And so we've seen an increase in interest in strategies that can pursue things like manufactured housing, student housing, senior housing, all other forms of living strategies. And so I think there's an effort to diversify away from just multifamily being the only way to play the demographics and the living. And there's all sorts of different flavors you can use to fill that bucket. And so we've had a lot of conversations with LPs about that dynamic. And so I think, definitionally that will mean less capital pursuing just a very traditional multifamily only fund because it's now competing with these other forms of residential for dollars.
Eh, Michelle, anything to add on that sector?
No, I think it mirrors all the other sectors too, where people are going into industrial now has many flavors, and people are looking for the alternative pieces within industrial. Housing has been the same thing, residential. I think that's true.
I would love to ask you about secondaries, both of you. What role are fund secondaries playing in the current market? Do we see an increase in interest around secondaries?
We've certainly seen an increase from our clients in understanding what is happening in the secondary market. I think the thesis of being able to buy something at a significant discount feels like an attractive opportunity, right? Who wouldn't make that trade if something's priced at $1 and you can get into it at 70 cents? A lot of times you would take that, subject to being in the right asset, right location, right sector. So there's been interest, right? I think the dynamic we're watching is the shift to the GP-led secondaries, right? That's made up the majority of real estate secondaries the last couple of years, less so on the traditional LP side, more on the GP-led and recap front. And that's a fundamentally different thesis. You're providing capital for a continued execution of some sort of business plan, not the sort of what I call old school LP secondaries, where you were hoping to buy a discount and just ride out the liquidation for the next 12 or 24 months. So it's a different risk and return profile, a little bit different return, business plan profile that goes with that compared to the historical secondaries. So a lot of that sort of math still to figure out. And if you look at the universe of funds that are out there, they're all very different, right? You have some that skew more towards the LP-led secondary side, some that skew more towards or exclusively GP-led. And so I think there is more differentiation in the product offering and the lineup. And so LPs are spending time really parsing the universe apart to understand what those differences are and figure out where they want to be aligning their capital. But in any environment where capital is at a premium, where liquidity is at a premium, I think secondaries are an attractive way to enter that if you can find the right entry point and right group to partner with.
Do you think investors are becoming more open to fund recaps?
I think they're accepting that more of them are happening. They're used to them, they know them from the private equity side, and they're understanding that if they want distributions back, they have to be open to a fund recap as a method to get distributions back out of portfolios because the traditional exit market just hasn't been there in volume. So they're they understand it. I don't know. I don't know if I would say they're accepting it if they're positive on it. It's another tool in the toolkit of how to generate liquidity, right? And I think more options are always good, but certain different LPs are going to have different perspectives, right? There's all sorts of potential conflicts that come along with recaps and continuation vehicles, and some LPs are much more skeptical about them, and others have used them more in other areas of their portfolio, so are a little bit more comfortable with those types of structures and those transactions.
Loretta, can I ask a question of Chris?
Yes, please.
So kind of a close cousin to portfolio recaps, right? I'd love to hear your thoughts about the continuation funds because that's you've seen more and more of that out there. Certainly. So I just would love to hear your thoughts on how you all view continuation funds, how you're seeing investors view continuation funds, and whether that's changed over the past 3 to 5 years.
Sure. Again, I feel like I'm a little bit of a broken record in that every client's going to view them a little bit differently, right? No, there's no one way that all of our clients are looking at continuation funds. Again, it's been a tool to create liquidity where liquidity has been needed or been requested from LPs. And so from that perspective, it gives you an option to take your capital. And frankly, that's what I think. I don't have the numbers in front of me, but my hunch is more of our clients have taken the liquidity option on CVs within real estate over the past couple of years as one of their only options to get liquidity over electing to roll and continue on. Though we have seen a little bit of both. Other than that, it's hard for me to put a strong comment on because it is very much it depends on the LP's preferences, depends on their portfolio needs, right? Do they need more of whatever the continuation vehicle is going to provide to them? If they like the asset and it fits their portfolio, why would you sell it just to go buy it somewhere else and add it back to the portfolio, right? You save the frictional cost of transacting. But again, there's always the potential or the skepticism around potential conflicts of interest. Is it being CV'd because it can't exit into the market? Are we rolling into a suboptimal situation? So I think a lot of these things need to be answered, and transparency certainly helps. It feels like GPs are getting more and more transparent as they come to market with these things on the whole, and LPs rightly so are asking a lot of questions before they go. It's no longer a check the box exercise. You get the 2-page approval and you check in and say yes, we want to roll. There's a lot of thought and a lot of diligence that's been going into each and every CV that we've seen come through.
Yeah, thanks. I know I've heard people talk about continuation vehicle language going into PPMs and LPAs a lot more now at the outset, but I'm curious if you actually are seeing an increase in actual continuation vehicles as a result of that, or if it's just going into the language is just going into the docs.
We've seen we've seen more certainly over the last 2 to 3 years than we saw the 5 years before that.
Thanks.
One thing that we, I think, talked a little bit about during our prep call that we haven't gotten into yet is co-investment. And, investors' desire for co-investment and what they're sort of hoping for and what's driving those trends. Chris, do you want to kind of touch on co-investment a little bit as well?
Yeah, happy to. It's certainly more topical, and I think there's really two primary factors that drive the interest in co-investment from LPs. One is the ability to average down your overall cost, right? Co-investment comes at a lower fee, lower carry, and if all else equal, you're in good deals that you like and you want more of in your portfolio. who wouldn't take a lower cost to do that? And a little bit of it is also more portfolio control, more ability to shape your portfolio, overweight your allocations to sectors or markets that you want more exposure to, alongside a GP that's already a trusted partner. You're in the fund in most cases, so you've already underwritten the manager. You're comfortable with their capabilities, and you're able to just deploy a little bit more capital at lower cost alongside that and help shape what you need in your portfolio. So I think those are the two primary drivers for co-investment. Again, the use of co-investment, the frequency with which it actually gets executed depends. Is it, if LPs have a co-investment program already set up or a third party that's running co-investments, they tend to be a little bit more active. If it's groups that maybe haven't gone through the process of thinking through a co-investment policy and a co-investment process, then it's a little bit harder, right? Because co-investments are often on relatively short timelines, and there still are some LPs that just don't have the staffing and resources to really participate in those sorts of short fuse type of transactions.
I have another question from the audience. I had alluded to sort of a just fee breaks not necessarily being enough to bring investors into a first close. What incentives do you see actually working to attract LPs to come into a fund's first close?
Chris, I'll send this your way.
Sure.
I have some thoughts, but I think that you're a more objective source for that. So
Yeah, I mean, to the discussion we had earlier, I don't know that the incentives alone are attracting LPs into the first close. I think it's, you know, if they're coming into the first close, it's because they've underwritten the fund and the strategy, and they like the GP. Oftentimes, it's a re-up. Particularly if they're a first-time closer, it's unusual to see a client go into a first close of a new fund. They want to take a little bit of time to get to know it and see the GP deploy some capital. So, for us, it's always a second question is what are the incentives? It's never the decision is made based on the incentives. So it's hard to really say, is it 25? Is it 50? Is it a 6-month fee holiday, a year? I've seen fee structures offer first closers reduced carry as an example, or maybe a higher hurdle as part of that. So these are all think of it as like ingredients for a recipe, right? These are all the things that can be offered, and we've seen them offered in different combination. But I don't know that there's any single one that you can say, okay, this is what's going to get an LP into a fund on a first close. A good product, a good strategy, and a great track record is going to get them in on a first close, not a fee discount.
Yeah, it's not about the little levers you can press if the fund can't attract the investor in the first place.
Right.
Um, we kind of talked about this a little bit before, but maybe we can kind of dig into this a little bit. You mentioned the total portfolio approach, Michelle. That's definitely something that we're hearing a lot more talk about lately, whether it's really happening beyond some pretty big names in California. Um, but how does real estate continue to compete for capital against the other sort of private markets, private equity, private credit, infrastructure, et cetera? What does real estate need to do to continue to raise capital and attract investors in the current environment? And I am actually going to put this on you a little bit, Michelle. What do you see, and your lens being more real estate debt, what do you see real estate having to do to attract investors in competition with these other classes?
I mean, I think transparency and information is really essential in this way because it's all about, I feel like I've probably mentioned this before, so sorry for repeating myself, but it is all about what's driving your returns and what's going to potentially hurt your returns. What's it correlated with? Like really understanding what those levers are from a characteristics perspective becomes essential because that's the only way you can really compare apples to apples when you are deciding. I mean, think about it personally, right? Like when you think about investing your portfolio, we're less institutional as individuals, right? We're just more like, okay, I want to make as much return as I can for as little risk as I can, and I've got this much investment horizon, and this is how much I can stand to lose or lose on paper before I get an ulcer or before I lose something. And you think about it from that perspective. I really think TPA is much more aligned with that in many ways because it's getting back to very basic return driver, risk, correlation, information. And I think what we've talked about here a lot, and I think what we've seen in the industry is real estate is much more varied and complicated and diverse than ever before. I would say that's probably true of the other asset classes too. But so as managers, it's on us to really help investors figure out who we are, what we do, what's going to make us different than or complementary or overlap with what they already have.
Hmm. Chris, what does real estate need to do to compete against other asset classes?
Yeah, I mean, I echo a lot of what Michelle said. I think it needs to define its role in the portfolio, to identify what it brings to a more holistic portfolio approach. So what are the differentiators? What are the diversifiers compared to infrastructure, compared to private equity? Often, most LPs think of it sitting in between those two, right? But really, what different does real estate provide versus those two asset classes? And again, the transparency and really the sort of the risk breakdown, right? What are the building blocks to risk and return in real estate, and how are they different than the other asset classes? What we need to do a good job of defining. And again, echoing Michelle, is just getting more and more complex every day, right? There's more sectors, more subsectors to be getting into, and each of them has a different profile. So just the transparency and continued bringing to light of those factors, I think will help compete with capital from the other asset classes.
What we've looked at today, the data that we've shared, is very institutional data. But one thing that we hear a lot about is the growth of private wealth capital. What do you think the growth of private wealth capital how might it change institutional real estate investing? Heather, if you want
I
to.
I would say in general, most of my focus is institutional, but I've worked with firms, including my existing firm that has a very large high net worth base too, an RIA channel. And I would say in general, when I've talked to RIAs or those that are representing more retail capital, the questions are more widely varied. Institutional capital in allocators have a more narrow set of questions that get very deep very quickly. Whereas when I go to meetings with RIAs or high net worth investor driven capital, the questions are out of left field, out of right field. Like they echo more of what I would maybe sadly, or not sadly, like a poorly classify as like a TPA. It's just more pragmatic in some ways, right? Not to say institutional capital is not very pragmatic, because it is, but it's more about like, wait, what's going to make this work well? What's not going to make it work well? Because of that, I think it drives more of that questions that we talked about before, like what does real estate need to do to compete with other asset classes? I think in some ways, the more that private capital is adopted by RIA and the high net worth channel and retail investors, the more it asks those basic questions. Let's not get theoretical here. Let's really talk, blocking and tackling. What is this going to do in my portfolio? What's it going to look like? When's it going to go wrong? When's it going to go right? So I don't know. I think we, as an industry, we invite more questions because it makes everybody stronger and sharper, and it hopefully helps us to do a better job for all the investors. But I think they're just going to bring a different perspective to the table.
Chris, anything to add here?
Yeah, I mean, I think the only other thing I've add with the caveat that we don't spend a lot of our time on the private wealth channels is it brings more liquidity, right? More capital into the market, more liquidity for purchasing assets, more liquidity for trading assets, which can be a positive, right? The thing that will continue to watch is what does that mean on the capital outflow side? As we know, the private wealth channel, retail money, has tended to be more flighty sometimes, driven by headlines as opposed to fundamentals, right? And that can have a severe negative impact if you start to see a lot of capital try to be sucked out of the system at the wrong time. And so really making sure that number one, to Michelle's point again, they understand what this is supposed to do in their portfolio, more importantly, what it's not supposed to do, and what are we getting into? I think a lot of the headlines around liquidity that we're seeing even in evergreen private credit funds are as much driven by people who didn't understand the product they were getting into. They didn't understand the 5% quarterly gating. These funds are doing exactly what they said they were going to do, but no one really understood what they said they were going to do, and now are upset by it. And so I think making sure that there is good education about what is the role of this, and how can it actually function, to make sure everyone's coming in eyes wide open will be important. But those are kind of my two biggest things that I think it will impact. Again, I don't spend a lot of my time on the private wealth side of it, so probably a little bit less nuanced view than others might have.
But before we wrap up and I ask each of you for your key takeaways, I am gonna put you on the spot one more time, Chris, because we have a question from the audience, just for you.
Great.
When evaluating an investment manager, what are the top three attributes that distinguish a best manager from the rest?
I'll put my phrase on repeat and say that there's no single answer for this for every manager, right? Every manager, every strategy, every product is different. And so what differentiates one product might not differentiate something else. Just to use an example here, a very small fund being raised by a shop that has one key decision maker, that key decision maker is going to be much more important than if I'm talking to a $20 billion Odyssey fund where if one person leaves it's not that big of a deal, right? So that the alignment for that one individual might be very important in one case and not important in another. I think overall, very high level, we want to see the things that differentiate a manager are either a unique view or a unique execution capability that's not easily replicable. So, effectively a moat around your approach that not the next manager that comes through my door can't replicate. A team that is well aligned and incentivized, right? Making sure the incentives are correct and designed to keep people there and behaving in the appropriate way. Those are all positives. So things that we would look for. And if there is, and I'm not saying this is a requisite, if there is a track record of executing that strategy, great. That's not to say if it's a newer fund, it can't be rated well, but it certainly helps to have something to point to and say, we've been executing this strategy for a while. Here's how we've done. Like here's the proof to back it up. Um, but again, we don't have, for example, a static weighting to these factors and say one gets X percent of the score, one gets Y percent. It's all very dynamic depending on the unique attributes of a particular strategy or offering.
Thank you. So we are starting to wrap up here. And I will say, ask each of you to kind of provide what are your key takeaways on the current real estate fundraising environment. I'm going to go ahead and start with you on this, Michelle.
And I would say generally it's healthy and getting better. It's still hard. Nothing is easy. There's a lot of competition and there's a lot of funds that are trying to break into scene. And I think it's a well-known theme that allocators have less and less time, and they are trying to fill their time. They're trying to consolidate the number of conversations they have to have, right? So you have to break into that scene. If you're not already well entrenched, you've got to break into that, and that's a hard thing to do. So I think that's the downside of having mega funds, right? Is if for the industry, the downside is that you create more of a barrier to entry for firms that could come up and help and really do a great job. I think we see that with the corporation scene as well in general. But I think in general, I think it's healthy. It's getting better. I feel like it's recovery in slow-mo. I feel like we've been in slow-mo recovery for a few years, but it's heading the right direction. So I'm very optimistic about things.
Chris, key takeaways for our audience?
Yeah, I would say similar. It's been a kind of a year and a half progression of recovery of capital raising, starting to see more pockets of distribution happening, and I think that will further the ability of LPs to recommit, and whether it's re-upping with existing GPs, whether it's exploring new strategies, that return of liquidity and exits from their existing portfolio will help drive that. And so cautiously optimistic on the future momentum of capital raising. And on the other side, it is getting very granular and more differentiated. You can no longer look to allocate across your four main property types and call it a day. There's now, I haven't done the math, but if you add up all the subsectors, there's dozens and dozens now of things that you could in theory be looking at, and it's just a more complex environment to determine, number one, where LPs want to be building conviction in their portfolio, and number two, it's very competitive on the capital raising side, right? Because it's taking a long time to raise capital, more and more funds are remaining in market, overlapping with the funds that are coming to market. So it's a challenge. There's a lot of funds out there and a lot of good funds out there, a lot of very strong firms looking to raise capital. And so very, very competitive environment today.
Well, I would just like to thank you both for joining us. Thank the audience. I'd like to thank the IRE.IQ Data Services team, especially Nico Peppas and Director Karen Palma, as well as the rest of my colleagues for putting together this information. As a reminder for the audience, all the data discussed in the program comes from our IRE.IQ database. IRE.IQ includes information on organizations, investment programs, and industry contacts. and it tracks more than 6,000 global institutional real estate investment programs, more than 1,100 of which are actively in the market now and seeking to raise a combined total of more than $500 billion from institutional investors. Publication sponsors receive access to IRE.IQ as part of their benefits package, but if you are not a sponsor and interested in using IRE.IQ, you can subscribe by clicking on the IRE.IQ logo on our website. Our next IRE.IQ fundraising report review will cover third quarter fundraising, and the webinar will take place November 10th. Thank you all. Have a great rest of your day.